Okay, let's unpack this. We're diving deep into FGV Holdings Burhead today. They're a major player, obviously, in a global agribusiness based right here in Malaysia. And, well, there's quite a bit happening with them right now.
Yeah, definitely. It's a company with, its fingers in a lot of pies within the sector. And for this deep dive, we've pulled together quite a bit of material. We've got their latest Q1 2025 financials, the previous Q4 2024 report for comparison, their press release,
Right.
analyst reports from MIDF and TA Securities, and also a pretty interesting article from i3 Investor looking at a very recent development.
Exactly. So our mission here is really to cut through all these documents, all the noise, and get to the core of what's happening with FGV. We want to understand, their recent performance, where they stand financially, what's driving the operations, and critically, some really significant recent events that could, well, shape their future. Especially important if you're looking at this as a potential investment.
We'll pull out the key insights, try and connect the dots between these different reports just to help you get a really well-informed picture of where FGV is at the moment.
All right, let's jump in. Starting with the headlines from the first quarter, the one that ended March 31st, 2025. How did they do on the top line, revenue-wise?
Okay, so looking at their unaudited report and the press release, FGV saw a healthy bump in revenue. It rose by 11%, came in at RM 5.04 billion in Q1 2025, which is up from RM 4.54 billion in the same quarter last year, Q1 2024.
An 11% jump in revenue, that's pretty positive. Did that actually flow through down to the bottom line? Profits?
It did, yeah. Operating profit showed a significant surge, actually, climbed almost 35%, 34.9 to be exact. That's RM 206.21 million in Q1 2025, up from around RM 153 million the year before.
Okay.
And profit before tax, PBT, that also saw a strong increase. It hit RM 83 million this quarter compared to just RM 50 million in Q1 2024.
And the final number, profit after tax and minority interest, the pet in my figure.
That came in at RM 36 million for the quarter, which, compared to last year,
a big jump from RM 13 million.
Yeah, pretty significant improvement, more than double.
So the numbers certainly look better year on year. What were the main things driving this improvement, according to FGV themselves?
Well, the press release and the financial report are pretty clear on this. They put it down mainly to two things. First, a much higher average price they got for their crude palm oil, CPO.
CPO price.
Yeah, it averaged RM 4,784 per metric ton in Q1 2025. That's way up from RM 3,907 in Q1 2024.
Okay, that makes sense. And the second factor?
A notable turnaround in their core plantation division. That was key.
Right, that turnaround in plantations sounds like a really critical piece of the puzzle here. Let's dig into the different parts of the business then. How did the segments perform in Q1?
Sure. So the segment info in the report confirms it. Plantations was a key driver. It actually swung from a pretty big loss of about RM 62 million in Q1 2024, to a profit of just over RM 50 million, RM 50.67 million in Q1 2025. That's a massive swing.
Wow. That is dramatic. How did they manage that kind of turnaround in plantations specifically? Was it just price?
Price was a big part, but not only that, several operational factors helped too. They saw a 5% increase in their fresh fruit bunch, FFB, production. That went up to 0.77 million metric tons from 0.74 million.
Okay.
And this also meant a higher yield per hectare, 3.05 metric tons, compared to 2.88 last year.
Better yields, more production.
Exactly. And on top of that, the price they received for that FFB jumped by 24%, hitting RM 974 per metric ton.
So they produced more fruit, got more from each hectare, and received a higher price for it. Sounds like a strong operational quarter for plantations, helped along by those higher CPO prices.
Pretty much sums it up. Their R&D segment, particularly the fertilizer business, also chipped in positively with better margins and sales volume, and they also booked a lower impairment loss on some financial assets this quarter compared to last year.
Were there any drags within the plantation division itself? Anything pulling the profit down?
Yes, one notable accounting charge was actually higher this quarter. It's the fair value charge on the land lease agreement, the LLA.
The LLA charge, remind me what that covers exactly.
It's basically an accounting cost linked to the land they lease from Felda. It increased to about RM 116 million, up from RM 86 million in Q1 2024. So that did partially offset some of the gains from operations and the higher prices.
Okay, interesting to see that year-on-year improvement. But how did plantations compare to the quarter just before this one, Q4 2024?
A good question. Compared to Q4 2024, the plantation profit was actually lower. It was RM 50.67 million versus about RM 126 million in Q4.
Lower than Q4. Why was that?
Well, even if you take out some non-financial asset impairments they had in Q4, the profit was still down quarter on quarter. The main reasons given were a 12% decrease in FFB production compared to Q4. Q4 production was higher at 1.06 million tons.
Okay. Seasonal, maybe?
Likely. Lower yield as well, and that increased LLA charge we just talked about was also higher than in Q4. So yes, a strong recovery compared to last year, but a sequential dip from the end of 2024.
Right. Okay. That gives us a clear picture of the main engine, Plantations. What about the other divisions? How did oils and fats perform?
The oils and fats division, well, it had a more challenging quarter. It actually reported a loss of RM 11.57 million in Q1 2025.
A loss. How does that compare?
It's a decline. They made a profit of about RM 20 million in Q4 2024 and a profit of RM 26 million back in Q1 2024. So yeah, a negative swing there.
Why the shift to a loss in that downstream segment?
The report points mainly to lower margins in their bulk commodities business and also reduced sales volume overall. Profits in chemicals and edible oils were also down, mostly because of lower shipment volumes, even though margins had apparently improved a bit in those specific areas.
Okay, so challenges downstream there. And how did the sugar division fare, MSM?
Sugar also saw a pretty significant drop in profitability. It posted a profit of just RM 111.46 million in Q1 2025.
Just 11.46 million. How does that compare?
Sharply down. It was over RM 67 million in Q1 2024 and nearly RM 97 million just in the previous quarter, Q4 2024. So a substantial decrease.
Wow, yeah, that's a big drop, both year on year and quarter on quarter. What caused that?
Compared to Q1 last year, it was mainly reduced margins, lower sales volume, and lower capacity utilization at their refineries. And compared to Q4 2024, again, lower sales volume and reduced margins were the main culprits. Interestingly, average selling prices were actually higher than Q4.
But costs went up more.
Exactly. Higher production costs just wiped out the benefit of those higher selling prices. The report does mention, though, that they're doing rectification work at the MSM Johor refinery. They expect this to increase utilization, hopefully above 50%, cut costs, and improve profitability and maybe their export position.
Okay, so it sounds like there's some specific operational efforts underway to try and address those challenges in sugar. What about the last one, logistics and support?
That division was fairly stable year on year, but down slightly. Profit was RM 32.47 million in Q1 2025 compared to RM 32.59 million in Q1 2024, so almost flat.
And the reason for that slight dip?
It was due to reduced tonnage handled in the logistics segment, but that was partly offset by a better result from their IT segment. Compared to Q4 2024, though, the profit was lower, down from about RM 40 million. That sequential drop was mainly due to lower profits from the IT segment this time, and also a decrease in performance from their travel business.
The travel business.
Yeah, apparently it benefited from Hajj season income in Q4, which obviously wasn't there in Q1.
Right, makes sense. So, okay, the big picture for Q1 results. Significantly boosted by CPO prices and that plantation turnaround compared to last year, but some definite headwinds in the downstream segments like oils and fats and sugar, and a bit of a dip in logistics quarter on quarter. Let's shift gears a bit. Let's look at FGV's overall financial position and how cash moved around during the quarter. The balance sheet.
Sure. Looking at the balance sheet as at March 31st, 2025, total equity stood at RM 7.43 billion. That's a slight decrease from RM 7.62 billion at the end of December 2024.
Okay, and assets, property, plant, equipment.
PP&E saw a small increase, actually, rose to RM 8.21 billion from RM 8.12 billion.
How did cash flow from their actual operations look? Were they generating cash?
Yes, cash flows from operating activities generated RM 38.84 million in Q1 2025, which was, interestingly, quite comparable to the RM 42.49 million generated in Q1 2024. So core operations still generating positive cash at a similar level to last year.
Okay, stable operating cash flow. What about cash used for investing and financing activities?
Right. Cash used in investing activities was higher this quarter. It totaled about RM 260 million compared to roughly RM 200 million in Q1 2024.
Why the increased investment spending?
Primarily due to higher purchases of property, plant, and equipment. So it suggests ongoing capital expenditure, maybe on replanting or infrastructure.
Okay. And financing cash flow.
That saw a really significant swing. They used RM 227.75 million in financing activities in Q1 2025. Now that's a huge change from Q1 2024 when financing activities actually generated about RM 475 million in cash.
Wow, yeah. From generating nearly $500 million to using over $200 million, what drove that massive shift in financing cash flow?
Well, the report highlights two main things influencing this. First, a higher repayment of borrowings. They repaid RM 2.65 billion in loans this quarter, compared to about RM 2.05 billion last year.
Paying down more debt.
Exactly. And second, notably, dividend payments. FGV paid out RM 182.41 million in dividends in Q1 2025. They paid 0 dividends in Q1 2024.
Ah, okay. So paying down more debt and paying a substantial dividend really flipped the financing cash flow number.
Precisely. So you put that together, operating cash was stable, but they spent more on assets, and significantly more cash went out for debt repayment and dividends.
Which means the overall cash position
Took a hit. Overall, there was a net decrease in cash and cash equivalents of almost $500 million, RM 481.93 million during Q1 2025. This brought their cash balance down to RM 1.24 billion at the end of March, from RM 1.73 billion at the start of the year.
Right. And looking forward, what about their commitments for future spending? Any major CapEx plans locked in?
It's slightly confusing in the report, actually. Capital commitments for property, plant, and equipment approved and contracted for are listed as RM 248.75 million. But the report explicitly states this figure is as at 31 March 2024, even though it's in the Q1 2025 column.
This seems like a typo.
It does. For context, the Q4 2024 report showed commitments of about RM 510 million as at the end of December 2024. So maybe commitments have come down, or maybe it's just a reporting issue. We'll report the figure presented, which is the older one.
Okay, noted. And their total debt level? Total borrowings?
Total borrowings as at 31 March 2024 were RM 4.04 billion. Again, the Q1 2025 report references the note from Q1 2024 for this breakdown.
Okay. Let's look beyond the numbers for a moment. What's FGV's own take on their strategic outlook? What external factors are they watching?
Well, the prospects section in the Q1 report suggests they expect CPO prices might ease a bit in the coming months.
Ease? Why is that?
They cite things like improved supply, maybe better weather, seasonally higher FFB production cycles coming up, and perhaps less demand pressure after recent festive periods.
Are there bigger sort of global economic factors they're keeping an eye on?
Yes, they do mention potential global headwinds, things like rising trade tensions, the possibility of new tariffs being introduced, and maybe slower demand for biodiesel. All things that could, put a damper on commodity market sentiment.
So given that outlook, potentially softer CPO prices, global uncertainty, how does FGV plan to navigate this? What's the strategy?
The plan, according to them, is to really double down on enhancing productivity and efficiency right across their operations, trying to control costs and improve output to meet their 2025 targets. They also mention wanting to strengthen market penetration, grow domestic market share, and looking longer term, diversify more into higher value, fast-moving consumer goods, FMCG products, and also expand internationally.
So operational focus and diversification.
Pretty much.
Yeah.
And the report also makes sure to emphasize their ongoing commitment to sustainability and their key stakeholders, like the Felda settlers and smallholders.
Okay. So what's their overall feeling about the full financial year 2025?
Optimistic. Cautious. The wording used by the board is that they anticipate a satisfactory performance for the full year, but they immediately follow that by saying they're aware of the ongoing challenges and uncertainties. So cautiously optimistic, maybe?
Satisfactory performance.
I got it.
Okay, moving away from the core financials and strategy, the reports also mention FGV's dealings with related parties and some ongoing legal cases. Given FGV's history and structure, especially its ties to Felda, this seems like an important area.
Absolutely. It's complex. FGV has significant transactions with related parties. No surprise there. The big one is Felda and its various subsidiaries. This covers things like FGV buying FFB from Felda estates, selling fertilizer back to them, providing IT services, security services, a whole range of things.
Right, interlinked.
Very. And they also have transactions with other government agencies, things like receiving cooking oil subsidies or sugar incentives, paying windfall taxes and CES, and even providing IT solutions to government bodies.
Okay, and what about those litigation cases mentioned? Anything major investors should be aware of?
The reports detail several material cases. There's one involving a claim against FGV Pro Data Systems about a VDSL project. A full trial for that is set for June 2025. FGV's subsidiary believes it has a fair chance of defending it.
Okay. Any others?
There's also a suit FGV filed against some of its former directors and employees related to an acquisition. Trial dates for that are scheduled for September 2025.
And those land claims you mentioned earlier, they sounded potentially significant given land is a core asset.
Yes, exactly. There are several ongoing land claims. These involve allegations like fraudulent transactions, trespass on native title lands, issues with subleases. Now, in some of these cases, FGV subsidiaries actually went to the high court and successfully got the claim struck out.
Okay, so FGV won those rounds.
They did, but appeals against those decisions have been filed by the plaintiffs. Those appeals are scheduled to be heard in late 2025. There was one case where the plaintiff didn't appeal the striking out, but overall, FGV states in the report that it believes it has a reasonable chance of ultimately succeeding in getting these claims struck out.
All right. Now, this is where things get, as you said earlier, really interesting because several major events happened after the Q1 reporting period ended March 31st. These are crucial updates.
Definitely. These post-period events are game changers, potentially. First up relates to their public shareholding spread the minimum percentage of shares that must be held by the public.
Right. They've had issues meeting that requirement before.
They have. And Bursa Securities, the stock exchange operator, actually rejected FGV's latest application for another extension to comply. Bursa has directed FGV to fix this breach by September 10th, 2025. So the clock is ticking on that. FGV says it's talking with Felda and others about what steps to take.
Okay, so regulatory pressure there regarding the shareholding. What else happened recently? Any big corporate moves?
Yes. On May 23rd, just a few weeks ago, FGV announced some proposed acquisitions by its subsidiaries. FGV Palm Industries and Felda Holding Burhead plan to buy the remaining shares they don't own in several subsidiaries. From Koperasi Permodalan, Felda Malaysia Burhead, KPF. The total cash involved is around RM 230 million.
So consolidating ownership within the group.
Seems like it. These deals need approvals, including from FGV's own non-interested shareholders at an EGM and extraordinary general meeting. They expect these to be done by Q3 2025.
Okay, so plans to buy out minority partners in some subsidiaries, and then just days later, the really big news drop.
Exactly. On May 26th, the FGV board got a formal notice. It came from Maybank Investment Bank, acting on behalf of Felda, and it was for an unconditional voluntary takeover offer.
Unconditional, meaning Felda wants to buy all the remaining FGV shares it doesn't already own, taking the company private and the price.
The offer price stated in the notice is RM 1.30 per share to be paid in cash.
RM 1.30.
Yep. And it's unconditional because Felda already holds over 50% of the shares, so they don't need a minimum number of acceptances for the offer to proceed. It just needs to stay open for at least 21 days once formally made.
Right. And very interestingly, the report notes that on the exact same day they received this takeover offer notice, the FGV board decided not to proceed with some previously announced plans. They were planning bonus issues and changes to the company's constitution.
That's right. They explicitly stated the decision to scrap those plans was made in light of the takeover offer.
So the privatization offer immediately put the brakes on other corporate actions FGV had in the works, which leads us nicely to that i3 Investor article you mentioned, which has a very strong opinion on this RM 1.30 offer price.
It certainly does. This source pulls no punches. The headline basically argues that the RM 1.30 privatization offer from Felda is, quote, just too low.
Okay, just too low. That's a bold claim. What's their reasoning? What's the basis for that argument?
Well, the author, Calvin Toon, starts by immediately pointing out the huge gap between this offer price and FGV's original IPO price back in the day.
Which is much higher, right?
Much higher, RM 4.55. So the article frames the RM 1.30 offer as a huge 77.5% discount to IPO. The author contrasts this sharply with the usual expectation that privatization offers often come at a premium, not a massive discount to the IPO price.
Okay, so point one is the historical context, the IPO price versus the offer. What about the company's current value? Does the article address that?
It compares the RM 1.30 offer price to FGV's stated net asset value, or NAV. The article puts FGV's NAV at RM 1.63 per share.
RM 1.63 NAV versus RM 1.30 offer.
Exactly. So the offer is 33 cents below the book value of the company's assets per share. The argument is that any fair offer should really be closer to the NAV, if not above it.
Makes sense. But you said the core of the argument, the really compelling part, was about the land value.
Precisely. This is where the argument gets really strong. The author contends that FGV, much like the B-plant situation previously, is sitting on what they call gold mine lands, lands that are massively undervalued on the company's books.
Which land specifically?
They specifically highlight FGV's significant land holdings down in Johor, mentioning locations from the annual report like Kulai, Plentong, Pasir Gudang, and the Tanjung Langsat Industrial Complex area, prime development areas.
Okay. And what's the crucial comparison the article makes about the value of this land?
This is the key bit. According to FGV's own annual report, the book value for nearly 35,000 hectares, that's about 85,000 acres in Johor, is listed at just RM 230.63 million.
Okay.
Now, if you do the math on that, it breaks down to a book value of only RM 2,703 per acre. Or get this, just 6.2 cents per square foot on the book.
Wait. RM 2,703 per acre for land in places like Kulai or near Pasir Gudang in Johor. That sounds incredibly low.
It really does, especially when the article contrasts it with recent actual market transactions in the booming Iskandar Johor region. It gives examples like Scientex buying land in Pulai for roughly RM 1.1 million per acre, or KSL Holdings buying land in Johor Bahru for about RM 1.15 million per acre.
Wow. Okay, so we're talking about market deals happening at over R1,000,000 per acre, while FGV's books list potentially similar strategic land at just over RM 20,700 per acre. That's a staggering difference.
It really highlights the author's point vividly, doesn't it? The article concludes, quite forcefully, that taking over FGV at RM 1.30 per share when its lands haven't been revalued and sit on the books at RM 2,703 per acre is, quote, grossly undervalued. The author even questions how analysts could possibly justify RM 1.30 as a fair price given this potential hidden value, and comments from other users on that platform seem to echo the sentiment that the price is too low.
Yeah, that discrepancy in valuation perspective is absolutely critical for anyone following this situation. The i3 investor discussion also apparently looked at what might happen next, the potential scenarios for this takeover bid.
Yes, the article on the discussion around it floated several potential ways this could play out. Scenario 1, the offer just fails. If Felda doesn't get acceptance from shareholders holding over 90% of the remaining shares by the deadline, the privatization attempt fails. FGV stays listed.
Okay, failure's one option. What else?
Scenario 2. Felda comes back with a higher offer. If RM 1.30 doesn't work, maybe they sweeten the deal. The author cited the KAF Seagroat case, where an initial RM 1.30 offer failed, but a later one at over RM 2.60 succeeded.
Interesting precedent. Scenario 3.
The offer fails, and FGV just carries on as a listed company. Maybe its capital base changes based on earlier plans, maybe not. The Harrison example was mentioned. A RM 1.30 privatization was blocked there, and the share price apparently went much higher later on.
Okay. What if the offer succeeds at RM 1.30?
Scenario 4. Felda successfully takes FGV private. Then perhaps they could revalue those assets, especially the land, hive off the most valuable bits, and sell them privately for potentially huge profits. The comparison made was to LTAT selling B-Plant's lands in Kulim for a reported 1,000% profit after that privatization.
Right. Unlocking value privately after delisting. Is there a fifth scenario?
Scenario 5. Felda takes it private, maybe restructures it, and then potentially relists it down the road, perhaps under a different name or structure. The Kulim JPG example was cited for this possibility.
Okay, those potential outcomes really highlight the uncertainty here and just how much potential value seems tied up in those land assets. How do the professional analysts, the ones from our sources, view FGV and this specific offer?
Let's look at TA Securities first. Their report came out May 29th. They rate FGV as accept offer. Their target price, or TP, is RM 1.30, matching the offer.
So they think shareholders should take the deal. Did they say why?
Well, they did revise their own earnings forecasts for FGV downwards for FY25 and FY26. They cited expectations of higher operating costs and lower contributions coming from the sugar and oils and fats divisions, so maybe seeing limited upside in the near term.
Okay, and the other analyst report from NDF Amana Investment Bank.
NIDF, also on May 29th, rates FGV as neutral. Not accept offer, but neutral.
Neutral, what's their reasoning?
Their view is that the outlook is pretty mixed. They see positives from the upstream plantation side, mostly driven by CPO prices, but they also expect continued margin pressure in the downstream segments because of higher input costs, like for refining feedstock.
So a more balanced, perhaps cautious view from NIDF. What about ESG factors? Environmental, social, governance. Did the analysts cover that?
Yes, both reports touched on ESG. TA Securities gives FGV a 3-star rating, out of 5 presumably. According to their methodology, this means FGV has adequate integration of ESG factors into operations, management, and future direction.
Okay, adequate. Does that rating impact their target price?
Their guideline says no change to the target price for a 3-star rating.
Right. And MDF's view on ESG.
MINDF references external ESG ratings from Bursa Malaysia and FTSE Russell. Based on those, they give FGV a 3-star rating as well. According to MINDF's guide, this puts FGV in the top 2650% by ESG ratings amongst public listed companies, or PLCs, in the FBM EMIS index that have been assessed by FTSE Russell.
Okay, so middle of the pack on ESG according to those ratings. So pulling this all together then, what does this really mean for someone looking at FGV right now? Where do things stand?
Well, you've got FGV delivering improved Q1 2025 results compared to the previous year, mainly driven by those stronger CPO prices and the big turnaround in their core plantation division. But at the same time, some of their other key businesses, like oils and fats and sugar, definitely faced significant challenges during that same quarter.
And financially?
Financially, operations were still generating cash, but the overall cash balance went down quite a bit in Q1. That was due to increased capital spending, paying back more debt, and importantly, resuming dividend payments.
But the elephant in the room, the really dominant story right now, is that unconditional takeover offer from Felda at RM 1,530 a share.
Absolutely. That offer is happening right alongside other moves, like FGV trying to consolidate ownership in some subsidiaries and also canceling previous plans for bonus issues because of the offer. It's all interconnected now.
And while the analysts we looked at have stances ranging from neutral to accept offer, with target prices right at that RM 1.30 bid level,
you have this very powerful counterargument, particularly from the i3 investor source, focusing on the offer price versus FGV's net asset value, and crucially, that potentially massive unrealized value sitting in its land bank, especially in those strategic Johor locations.
Yeah, that land valuation discrepancy is stark.
It really raises the fundamental question here.
Given the analysts seeing RM 1.30 as fair versus the argument that the underlying assets, particularly the land, could be worth significantly more, what is FGV's future?
Exactly. Is RM 1.30 actually fair value, or is there substantial hidden value here? Value that might only get unlocked if the privatization succeeds and Felda revalues or sells assets privately.
Or perhaps if the privatization fails, could the market eventually recognize that potential value if FGV remains listed?
It's a really complex situation for investors. You've got differing views on the core valuation, multiple potential paths forward depending on whether the takeover succeeds or fails, and underlying assets whose true market worth seems significantly disconnected from their book value. Definitely one to watch closely.